The threat of stagflation has not gone away. Of course, that would be persistent increases in prices while the economy stagnates. So that, for some investors, leads to a strategy of buying defensive stocks. Our guest has some ideas on that front. We're joined by Kash Pashootan, Chief Executive Officer at First Avenue Investment Counsel. It's great to see you. Thanks for joining us.
Thanks, Andy.
So essentially, part of your strategy here is you're looking for stocks that sell products that people need rather than want.
Yeah, exactly. Coming into this year, Andy, the earnings estimates for Canada and U.S. were for about 5% earnings growth. And for us, we scratched our head wondering how is that going to happen given the magnitude of interest rate hikes and a recession on the forefront. So we were defensive coming into this year, and there's multiple ways you can be defensive in a portfolio, but to keep things simple and really focus on underweight and overweighting sectors, that would mean reducing one's exposure to sectors like the cyclicals. And that would be things like commodities, manufacturing, areas or industries that tend to do really well when there's economic expansion and growth, and focus more on what you need to have or what you need to use, regardless of whether the economy is in a boom and bust. So we've rotated out of cyclicals for the most part. We're considerably underweight cyclicals compared to the benchmark, and we've overweighted consumer staples. And that's an area that investors can take a higher degree of comfort in that those tend to be products and services that we need, rain or shine. So sort of to give you an example, a good sort of rule of thumb for investors to use is stay away from the consumer wants, and look at the consumer needs. So the wants would be things like Apple, it would be things like Peloton, it would be things like automobiles, so Magna would be in that. And the needs, the consumer needs, would be businesses that, again, we have to use rain or shine. So, for example, UnitedHealth is an example of that. Waste management, products and services, again, that we're using rain or shine, boom or bust.
A Loblaw would fit into the category there?
Exactly. Loblaw is a big holding for us and a name that we really like. I mean, they obviously in the grocery space have significant market share. The President's Choice brand that they have gives them a lot of pricing power. They're not at the mercy of a third party. And the PC Optimum, I think, also for Loblaw is significant in the amount of consumer data that they get. They have a real pulse on what consumers are buying, what they're not, and that allows them to adjust prices effectively. So definitely Loblaw's in that mix.
It is interesting, the algorithms they have. The stock is near record highs as far as I know. Maybe we could put up a 10-year chart. The algorithms they have for figuring out our behavior.
Absolutely. You know, the grocery space as a whole is we believed for the last sort of 12 to 18 months that looks opportunistic because there's several factors working in its favor. When you think about the consumer trying to save money, they're spending less on Uber Eats and making more food at home. And so if you're cooking at home, obviously you're going to the grocery store more. And then Loblaw, obviously, with the algorithms we talked about with the PC Optimum, as well as PC Financial, right? So they have they have their tentacles in the consumer in multiple ways in a sector that we like.
It is interesting. I suppose one dilemma for you, though, as a portfolio manager must be eventually the market will start looking beyond the economic slowness and start buying the cyclicals again.
Definitely. And one thing we know about the market is it's always forward-looking. Yeah. So before it actually starts to happen in the real world, it happens in the market. And so the defensive tone that we've had has really started, I would say, last year. And we're now looking at how do we get more opportunistic? So although we have a defensive slant on the portfolio, we're spending a lot of time on what our portfolio management team calls the bull market strategy. And so we've identified stocks that are longer term holds, but then we also have stocks that we call rent to own, rent not own, I should say, stocks that we want to be in for the early stages of the recovery and not necessarily own them long term. And examples of that, and we saw it with COVID, would be names like Live Nation, Air Canada, right? Obviously, when everything was locked down, no one could go to a concert. You can imagine what happened to Live Nation's stock price. Air Canada, again, the airline industry historically, it's boom or bust. It's not a business we want to own long term, but the pent-up demand with travel really positioned an opportunity in air travel as things opened up again. So absolutely, we're positioned for the bull market, although we have a defensive slant on the portfolio. And the way that we're approaching the bull market is really long-term or prized assets or trophy assets, so companies that we want to own long-term that we're looking at loading up on, and then also stocks that we call rent not own, names that we want to own in the early stages of the bull market, but not necessarily be there long-term.
And what about the yield stocks like the utilities? Are you happy holding those these days?
Yeah, absolutely. I mean, look, utilities make a lot of sense. Utility stocks are companies that you wish you had more of in a bad market, and you scratch your head and say, why do I own these in a growth market? Because as we know, generally speaking, utility stocks are not growth stocks. It's really, you're getting modest share price appreciation in most cases, and you're getting a decent yield. And when you add the yield and the share price appreciation, you're banging out maybe 5-6% a year, and that's really what it's designed to do. So in this environment where investors are trying to be more defensive, utilities make a lot of sense. But the other factor that really affects utility share prices or any sort of yield stock is what happens with interest rates, right? As interest rates go up, it puts pressure on share price for those yield names, and that's already happened. So if we start to see rate cuts, you're going to see these yield stocks really take off.
What about the banks? The classic question. You've got to. That's almost the biggest decision in the Canadian stock market. Do I overweight or underweight the banks?
Yeah, look, we like the Canadian banks because obviously the word bank means something different if you're talking about U.S. regional banks compared to Canadian banks. But the tight hold that the Canadian banks have on the Canadian market means that it's almost a guaranteed great long-term investment. I'm very hesitant to use the word guaranteed, but over the long term, if you own Canadian banks, history has shown us you've done really well. So we like the Canadian banks. We obviously have a lot of exposure to the Canadian banks, but I would also add an asterisk to that to say that don't be surprised to see considerable volatility over the next year with Canadian banks, because as what we're seeing with the regionals in the U.S., that has a spillover effect into Canada. I mean, look at TD Bank. Today, TD Bank's the #1 most shorted stock in North America, right? And the stock was down, I think, about 3% just recently. So although these names are going to be great long-term, there's volatility. There's no free lunch. So we own them, and we like these businesses. We like TD Bank long-term, but we're also not naive to think that in the short term there's going to be volatility. I mean, look at the chart on TD. Yeah. It's really gotten a haircut. And so, again, there's no free lunch. If you want no volatility, GICs and savings accounts are where to be. But if you own quality businesses over the long term, you're going to do well. What this market gives you is an opportunity to step in and position your portfolio for the next 5 years. And that's when you have to be ready to pull the trigger and buy when it doesn't feel great.
Yeah, that's